Hi everyone, and welcome back to another simple daily practice drill I think you can use to become a better trader. And this one is about trading ranges. In particular, it's what I call hot zones. In this video, I'm going to explain how I like to trade a trading range, where it came from, and why I trade them in this way. I'm also going to give some examples across the last couple of days in the hope that you will research this technique further. So I think this is a useful exercise to do on the open. Let's look at the open of yesterday. So we can see yesterday is a doji bar. Okay, here's the open of the day. We went down, we went up, and we came back to the open. So this is a doji. This is a trading range, and there's a good chance if we just keep moving this fib across that range, the market is going to act like a trading range. And if you were aware of this fact yesterday, then you were looking to see whether it would have found support around these numbers. The other approach you can take is looking at where the wide stop is. If I'm a bull, my stop is at the low of the last bull spike down here. Now coming into the open, this is where the bull stop, the widest possible bull stop is. The bears have a variety of possible stops, one all the way up here, but the one that made sense on the open was here above yesterday's bar 76. And we spent the first hour and a half of the day going sideways. So I put a fib tool, which is breaking the range into thirds, and there's also a 50%, and I call this hot zone trading. Because the fast stop is all the way over there, I want to enter somewhere in the lower third, meaning my risk is going to be 1 and my reward is going to be 2. And if I'm a bear, I want to sell in the top third, so my risk is 1 and my reward is 2. This is the basis of the technique. You find where you think the stops are, and you use them as a place to find 1 to 2 trades. You already know bulls were buying in the lower third here, so it was reasonable to buy when it comes back in, but you missed here. On the way up, 4 bull bars is good, but we're below the moving average. A second attempt is good also, but this is not the area I want to be buying in. You can see traders sold the close of this bar. I think that technique's a little bit too aggressive if you're going to apply it. I think a better approach, or one I've found to be more practical when I'm day trading, is to see it fail once and take the second entry. But this is the start of a new session today, so this is more important for me. Here it fails once. Here was the second entry short. And this is where I was short yesterday. I did nothing in here. I was looking for a buy signal low, didn't get it. But then I got a sell signal high, and I thought, okay, I'll take it. Now this could have gone all the way up here and stopped me out. Once I got a good entry bar on 10, then I thought it was reasonable to hold short. While I'm in the trade, we've also gone below that bull bar, so that's good for me as well. If a trader took profits down here, that's okay, but now you're back in the middle of the range. So you finally entered in one of the hot zones, and you know the market's going to spend a lot of its time right in the middle. So I don't want to be getting out in this zone. I want to be entering in one of the zones, trying to kind of cross this chasm to the other side. Some traders will scalp a position at the midpoint, and some other traders will just trade back to the midpoint. That's fine. But once I've set this hot zone up, the best place for traders to get long, if it doesn't work in here, is in this lower third. So I'm taking a trade on momentum, hoping we're going to get to a place that's more valuable for bulls. Now, a bull was able to buy here. They could have bought in here. They could have bought in here, and their stop is very close. And that means their position can be larger. You're risking 17 points, and you're hoping to get up to this top third. You've got at least 2 to 1, even more. So this is actually a really good area for bulls to buy because of the traders equation. Now, one of the reasons I had to get out of my shorts down here was because the stop was there. Maybe the stop moved to here. On a lower time frame, the stop probably moved to there. And why can't the market that's already moved 50 points just not get that last 10 points down to run that stop? So I pulled my stop up. I brought my stop down And I thought, you know what? If we don't go down soon, I think I'll probably just get out. And I got out probably about, I think I got out on 27 or the low of 25, somewhere down here. We went below it once, we went below it a second time, and I thought, this is not doing what I want it to do. So that's one way that you can trade the hot zone successfully. Now, what if you did the opposite? Let's have a look at this day. So this is the open that I'm talking about. Where's the stop? Well, there's a possible stop location for the bears all the way up there. What about for a bull stop? You could have a bull stop there at the low of that bull spike. You might put it all the way down here, but on the open, I don't really care too much about that one. I care about the closest wide stop. I get my fib tool and I divide the area into thirds. I'm looking for buy signals in the top and I'm looking for sell signals in the bottom. You can see here consecutive bear bars, 3 bear bars looking to sell, betting it's a failed breakout. That's reasonable to sell up here. If you didn't sell up there before, now you're willing to bet this is not going to be successful. Here's a tail. I think it's too aggressive to buy such a strong spike at its low, but the second attempt is reasonable. I was long here on that day for this reason. I was not able to get long here because this is 4 bear bars in a row, and I thought we might get one more move down, and then now I'm back in the middle of the range. So you can see if you didn't trade outside of these ranges, you could have lost a lot of money in here. Down, reverse, up, reverse, down, reverse, up, reverse, down, reverse. At some point, you're going to be wrong. Al says once you've got about 3 legs in any directions, 1, 2, 3, 1, 2, 3, you've got a double top and you've got a double bottom. It's breakout mode. Now you need to stop fading the range. I highly recommend you practice this on loads of charts. Bear stop up here, bull stop down there. 1, 2, 3, 1, 2, 3. Now we're in breakout mode. It's probably better to trade the breakout. Same pattern again. So this technique is useful when we're in the range, but it has a limit. What about here? You're trading in the middle of this day and you decide, well, I'm not really sure what's going on. Looks like traders are selling in the top and they're buying in the bottom. It's important to recognize a couple of other factors. Here, the overall trend is down, and that means I'm more likely to be looking for sells in the top part of the range, but I might not be strongly looking for buys in the lower part of the range. This is a personal preference with this technique, and I encourage you to research it more and more. Another important thing to realize when using this technique, and we'll use this example, is the swing point is up here for the bears, but we just broke any swing point for the bulls. Originally, there were bulls here, but this bull stop got hit. And as long as we're hitting bull stops, I'm in a bear trend. And that's why this technique usually has a 5%. That's why I usually get 5% to one side or the other. What if you thought the swing point was all the way up here and you say, oh, look, that was just a test of the top of that range? I don't have a problem with you using wider and wider stops. The difficulty is if you sell here, that range is 60 points, which is an entire day of ES volatility. And I think most traders will have a problem selling and selling higher across multiple days. So I'm always wary of using a range that doesn't make sense in terms of the expected day trading volatility of the instrument. Can you use this on a micro time frame in terms of trading flags? We weren't able to go below the low of the range here. We've worked back out to the top third. The difficulty is in how you manage this bit. So rather than trying to sell here, which I think is aggressive, the better sell was here. And if you measure that out, I think we'll find that was closer to the measured move. So even though that had a really big risk reward, I think traders are going to find it easier to implement this strategy by trading with the spike as opposed to getting the most aggressive entry. This will also prevent you from buying when there's a bull breakout. It's the same reason why blindly buying somewhere in here is a bad idea. There's the 200 once again. You can use the 60-minute chart to improve this technique. Let's go back to a day that's in a trend. Here's the opposite example. This has been really strong. This is really strong. Once you see this, I think you have to remove these entries. I personally won't trade a wedge like this up here. Now I've got a strong breakout. I'm no longer interested in using this technique. I'm more interested in this. So the presence of strong breakouts taking out any swing points is a different behavior to the hot zones. So now you don't have to fear sideways trading. It can be prevalent for a few days. Well, thanks very much for watching. I hope you found that video valuable. In this video, we talked about trading ranges, in particular, a concept I call hot zones. I think it's a very useful technique when the market's in breakout mode and you're wondering where direction is going to go. By using this technique, it also prevents you from getting caught up in the middle of a tight range and taking repeated reversals. Thanks very much for watching. My name's Tim Fairweather from Zen Trading Tech, and I'll see you in the next video.